Well, the government has promised necessary measures to lift the economy, but will a fiscal stimulus throw the fiscal deficit math out of whack? That is the issue that we take up again on our editors' roundtable. There are two clear options before the government: increase revenues or borrow more. Now, sources tell us that North Bloc is not necessarily in favor of relaxing the fiscal deficit target just yet. That's the operative word, just yet. So can the government manage this tightrope walk? Latha, Prashant, Ekta join us now to discuss this further. Ekta, coming to you first, take us through the picture of where India's fiscal deficit currently stands. And while the central government's deficit has been reducing, the states are actually going the other way. So let's talk about the combined deficit and what that picture looks like.
Yes, absolutely. Well, I'm going to start with the historical analysis of fiscal deficit at the central level. Now, if you look at it, it's actually been reducing in the past couple of years. We were at heightened levels of around 6 to even 6.5% in FY09 and FY10, came down to levels of around 4.8% after that and rose back up close to 6% levels. So it's been volatile, but the trajectory has been lower. The latest data is that FY14 we stood at a fiscal deficit of around 4.5%. That reduced to a sub 4% figure for FY16, and currently the target for FY18 stands at around 3.2%. So what you can deduce is that over the years there has been a fiscal deficit reduction. Now, one of the reasons, and maybe this could be a correlation as well, is because of what's happening with oil prices. In FY13, FY14, we did see oil prices which were above $100 per barrel on an average for the entire fiscal, and that's when you saw the fiscal deficit rise to 4.5 to 4.9%. We've gradually seen it reduce from 80 in FY15 to around 49 in FY17, and currently at around 52.4 in FY18, giving you an indication that the reduced oil prices did reduce the burden that we saw from oil imports. Now, moving forward, the debt to GDP ratio is also a very important ratio which is tracked quite closely. Anything which is above 75% is a concern, and anything above 80% is trouble. So right now FY18 is estimated to be around 70-odd%, and this is currently with the bias that it could probably even be higher at this point in time. Lastly, just coming to the point that you mentioned about state fiscal deficit, you can see the two charts at this point that yes, while the central fiscal deficit has reduced, the state deficits have increased over a period of time. The budgeted estimate as per the RBI annual report stands at 2.3%, but the economist community is working with around 3%.
All right, that's the comparative picture when we look at fiscal deficit both at the centre as well as the state level. Ekta, many thanks. But here's Arundhati Bhattacharya, chairman of India's largest lender, the State Bank of India, speaking exclusively to CNbc in Europe on the sidelines of the SBI bond launch at the London Stock Exchange. She believes the government does have the fiscal headroom to take steps to boost growth. Listen in.
Things like energy prices are still low. That gives us quite a bit of leeway about how you really spend the revenues that you collect. The other thing that the government has done very well is targeting of the subsidies. It really reduces the leakage of subsidies from the system, and secondly, it allows for better targeting of the right recipients. Now, with that, the government should have enough fiscal space in order to carry out the reforms it needs to do, plus make the investments that it needs to make in order to boost the economy.
Well, that's Arundhati Bhattacharya saying that the government does have the fiscal space. In fact, let's go across now to Prashant Nair. Prashant, why do you believe the time is ripe for the government to go for a stimulus package? In fact, what you're suggesting is what the Confederation of Indian Industry is suggesting as well: deviate by 0.5% to provide stimulus to the economy. Prashant.
Oh, it's the economy, and I think the reasons are well known. Let's start straight away with the first point, which is if in financial year 18 growth slows down, it will be the second year that growth slows down. 17, we had a growth of 7.1%, remember, and many are saying that we might end up with a sub 7% growth this year. Private consumption growth has been doing very well. It constitutes 60% of GDP, but can it continue to grow because the government has front-loaded its expenditure in financial year 18. Exports, 20% of GDP, has slowed down pretty dramatically. Construction growth in real terms, big employment sector, has grown at 0.6% between October 16 and June 17. This was growing at between 4 and 6% earlier. You look at the formal economy sort of job creation, the jobs that we usually refer to when we talk about jobs. I mean, you know, they are down 3% year on year in the first half of 17. In 2016, this grew at about 11%, and this data is from Naukri, which is the job portal. Corporate upgrades to downgrades are at the lowest level since financial year 12. That's an indicator of corporate health. So these are the big reasons, the foundation on which this entire argument for a stimulus program really rests, that something needs to be done to stimulate the economy. But, you know, naysayers say you do a state spending program, inflation will shoot up. Look at the capacity utilization levels. And the reason I'm putting this up is because, you know, inflation will shoot up if the economy is running on full capacity, and then you put money into the people of into the hands of people, and then, you know, prices start to go up. But right now, core sector capacity utilization levels are pretty low, be it cement, power. Steel, of course, has done better, but that is essentially because of what the government has done to help the industry. Stimulus, what can be done really? PSU bank recap, additional impetus on housing scheme, and rural economy. But one thing is clear, I mean, it could be one of these three, or it could be a bunch of these three, it could be something else. But something, if you need an impact immediately, it has to be on the revenue expenditure side rather than capital expenditure, which is great, but it takes time to show up. And the big question really, which I think everybody has no sort of answers to really, is when will private expenditure pick up? Will a fiscal push from the government really push private sector to spend again? Can that kickstart the virtuous cycle? I think that question is up in the air. Back to you.
Does India need a stimulus at this point in time? Prashant was making the argument that it does. Now, will that mean deviation from the fiscal deficit target? CII says do 0.5%. That is what is needed. Let's go across to Lata now. Lata, if we were to deviate from the fiscal deficit target, from the path of fiscal consolidation, given the fact that people are now terming the GST as an exceptional circumstance, what is the reaction going to be? Let's talk about the pros and the perils of breaching.
Well, 4 quick points to tell you why this may be tough. One, there is a large community of economists who believe that the government is maybe reneging on the fiscal deficit even without any public stimulus package. One, because they have given a larger share of the GST to the states to cajole them into coming. So about half a percentage point of the GDP in terms of revenues is going to fall. Spectrum is going to take away another 0.1 because the rates are lower. They have been pushed back. So 0.1% of GDP goes away because of that. RBI dividend is half of last year. That takes away 0.2%. And there is you know, higher than expected losses also from HRA. The house rent allowance was not expected to be implemented this early. That's taking away another 0.1%. So they're already likely to renege on the deficit. This taking the encasing leeway of 0.5% will be taken without any stimulus itself is one fear. The second fear is that states, as Ekta pointed out, last year were 2.7% GDP deficit. This time it could be 3% because of farm loan waivers. So we will stand at 3.5% in the center, 3 in the states, 6.5%, and one of the other countries rated like us, Indonesia for instance, just for instance, is 2.9% fiscal deficit. So in our category, we are already serious outliers. A third reason is that, as Prashant was pointing out, the only thing that's firing is consumption. Now, if you have a higher fiscal deficit, you saw how the bond yields have already reacted. They've risen by about 10 basis points. If actually government borrowing rose, then you will see the bond yields go to 6.9. And that will mean, you know, NBFCs are borrowing more expensive. So that consumption, which probably was getting kick-started by cheaper loans, is probably going to get shaved off because the NBFCs are borrowing expensive. They will lend expensive. You will lose consumption, but will you really make any gains on public investment, which will take time? A fourth reason, exactly that. How much is the bureaucracy able to deliver? Remember, the NHAI started the year with 10,000 kilometers target. They've, in the last few days, whittled it down to 5,500, and they've actually bid out only about 600 kilometers. Will they even deliver if they're given money? That's the point. The only argument that perhaps will work is if that extra money is given to public sector banks, who will be able to perhaps, who will have to be given risk capital to write off their bad loans, and then given growth capital. So substantial amount of capital, which probably can also come below the the line, not as fiscal deficit, but as recap bonds. But, you know, we spoke to the State Bank of India managing director, and he said this is not just a supply problem, it's also a demand problem. How many credit-worthy infrastructure guys am I going to find is also an issue. So, you know, don't expect that just because you're able to give recap bonds or you're able to give capital, the banks will be able to lend and give growth. The chances are that the Finance Ministry and the PMO also is buying this argument. Last 3 years, they have delivered on fiscal deficit. I'm not very sure they are willing to renege on it for a song. It looks like they may even increase the fiscal deficit to ensure some stimulus. Is that a good thing to do?
Yeah, absolutely. I mean, remember, your deficit's been coming down. Your rupee has been getting stronger. The country's going at 5.7%. They should have their own goals and aspirations, and there are a lot of policy tools. But what they need to do is figure out which ones they want to execute, how they want to execute it, what they can accomplish, what the pros are and what the minuses are. So I don't think government should say, well, you can't get the deficit up at all. Like in the United States, I think competitive tax reform is more important than how it affects the deficit in 1 year. And so I think people should think about good long-term policies, spend more time thinking about that and why it's good to do, and not do the wrong thing because of a short-term number.
Well, that's Jamie Dimon saying, well, if you need to stimulate and you need to deviate from the path of fiscal consolidation, well, so be it.